Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is hot topics in global trade finance. My name's Evan DeCresce, and I'm a counsel in Mayor Brown's finance practice in New York. Joining me today is Pat Healy, an associate in our finance practice in our Chicago office. We're going to talk about a few hot topics in global trade finance, including combining features from securitization and factoring transactions, bankruptcy considerations, trade credit, back leverage, and more. So with that, let's begin. The first topic we were going to discuss was including the features of securitization and factoring transactions. I do a lot of work on the securitization side, and my colleague, Pat Healy, who should introduce himself, does a lot of work on the factoring side.
Hey, everybody.
So an issue that often arises in securitization transactions is that the total amount that can be financed, that in trade receivable securitizations strive to create a diverse pool of receivables against which to lend, on the idea that the risk of multiple obligors is uncorrelated, and the sponsor of the securitization can borrow against a diverse pool of receivables which performance should be uncorrelated. To ensure that there's not an excessive amount of correlation in the performance, there's limits on the amount of a particular obligor's receivables that can be financed in any given transaction. These are commonly referred to as excess concentrations. So you might have an obligor in a particular pool that has a very large share of a customer's business. In a lot of businesses today, there's often a limited market for the product. Companies like an Amazon or Walmart may have a very large, may constitute a very large portion of the pool. And in a securitization, you're not interested in effectively swapping the credit rating with another company's, but in a factoring transaction, that's precisely what you're going to do. So where you have these large concentrations that aren't suited to be financed in securitization, including those receivables in a separate factoring facility can be a very useful way to ensure that the borrower can get the maximum amount of borrowing capability. So with that, I'm going to turn over to Pat to talk about a few transactions that we've worked on where certain obligors could be effectively taken out of the securitization pool and put into the factoring pool.
Thanks, Evan. As Evan mentioned, typically sort of the hallmark of a factoring transaction as opposed to a securitization is that you're focusing on just a couple of obligors, and you're sort of taking a pretty large credit risk on those particular obligors. Traditionally, the way that you do that in conjunction with a securitization is to completely carve out those few obligors beforehand so that they're not actually even going into the securitization, and then those would be financed by a different bank. However, the new structure that we were seeing, which is adding this factoring on top of a securitization, allows those few excluded obligors to be funneled into the securitization, sort of giving some structural support to the transaction that you would see in a securitization. And then at that point, the SPV who owns those receivables sells it on to the factoring purchasers. Typically, to avoid any sort of big intercreditor issues, those purchasers are the same as the lender banks in the securitization. So we've seen, a number of transactions like this recently. I'd say sort of the big keys to these deals is one, you want to make sure that regardless of whether the receivables get factored into the factoring deal on top of the securitization, those obligors are typically going to be ineligible in the securitization. To the extent that they're sort of left in there and not actually factored off the top, they just provide boot collateral. But you want to avoid sort of a situation where you're fighting over whether receivables are in the factoring or whether they're in the securitization. Although, some of those are minimized by the fact that that you have the same banks in both pieces of the transaction.
Yeah, and Pat, I'd also note, I think we've seen deals where there's an intercreditor agreement to manage that, where you might have different levels of exposure among the bank group to the two transactions. Like if not every lender's in that transaction, there can be an intercreditor to manage that. And I think probably also some of the structural protections you can sort of piggyback on those additional structural protections like cash management and having a bankruptcy remote seller. I think you probably don't see that. That's not necessarily as tight in factoring as my understanding, but you might have more insight on that.
Yeah, in a typical factoring transaction, sort of outside of this securitization context, there usually isn't an SPV, and the receivables are sold directly by the operating company, to the financing provider. And yeah, you're right about the intercreditor. I would say that I think in all of the transactions we have, even though the bank groups are the same, there is an intercreditor agreement just to contemplate, any future scenarios where you did add some other party as receivables, as a factoring purchaser, for example. So you would have an intercreditor sort of in any event, and you're right, because typically the factoring proceeds, the collections are collected in the same accounts as the securitization receivables. So there's sort of unlimited commingling there. So there definitely needs to be an intercreditor, and they're also, it's very helpful to make sure that the bank groups are the same as well, to just sort of head those issues off.
Yeah, and I think probably one of the benefits you get by doing it as you sort of after the sale to the SPV is that you do get to piggyback on some of those additional protections as far as cash management and bankruptcy remoteness. So I guess with that, should we talk a little bit about bankruptcies and securitizations? This has been something that we see as potentially a big story in the coming year. In some ways, this is the next chapter of a trend that we've been talking about over the past few years, which is an increase in deals involving distressed companies. Over the last few years, we've seen more deals with companies that are either highly levered portfolio companies or are in distress. We've seen deals with CCC companies, single B companies, and as interest rates rise and the economic outlook gets a bit cloudier, we thought it could be worth discussing what happens when the music stops and the company can no longer service all that debt and goes into bankruptcy. So I guess starting off, the key to any securitization transaction is the premise that the transaction is remote from the bankruptcy risk of the originator, and that the lenders can recover from those securitized assets outside of the bankruptcy process. While this is feasible, it's not always the best or only path forward for lenders. As a company approaches bankruptcy, its lenders should be working with the company to negotiate the most favorable solution for them as well as the company. Typically, a company large enough to sponsor a trade receivable securitization is going to at least attempt to reorganize in Chapter 11. And by having control over the company's receivables, which are a key source of liquidity, the lender can have significant leverage in those negotiations. And while the lender could potentially liquidate the receivables pool outside of the bankruptcy process, meaning it would just block the accounts, take the collections, apply it to pay down its debt, and then turn over the rest to the company if there is any excess, which would be a liquidation outside of the bankruptcy scenario. Doing that poses risks for all parties involved. For one, how are those receivables being serviced? If you have a servicer that's in bankruptcy and isn't going to have access to these collections. It may not be incredibly motivated to work with you and do its absolute best job servicing those receivables. Receivables like trade receivables are really hard for third parties such as a bank to service. So while many of them may just self-liquidate because the obligors will just keep doing what they've always been doing and paying, there is some real risk there. There's a risk that disputes that weren't anticipated, executory contracts that aren't complete, and in doing this, it's also quite risky for the company. Any liquidation of the trade receivables is going to deprive the company of liquidity. It's going to interfere if the banks are directly notifying obligors. It's going to interfere with its commercial relationships, and this is going to be pretty destabilizing to the sort of broader reorganization efforts, both for the company and the company's other lenders. So in my experience, in the half dozen or so cases I've seen where the sponsor goes into bankruptcy, in all of those scenarios, some negotiated solution was desired ahead of a liquidation. Whether the other DIP lenders would pay off the securitization lender to prevent it from taking this disruptive action and interfering with commercial relationships and depriving the company of liquidity, or the securitization has continued into the bankruptcy. And that's often the most desirable from everyone's perspective. By participating in the bankruptcy process, the securitization lenders can avoid a messy and potentially contested liquidation process. And in doing so, they can also obtain various court-ordered protections. For instance, a blessing of the continued sale of receivables to the SPV, a blessing of their lien priority and relationship vis-a-vis the DIP lenders. There's also significant commercial upside. In these deals, we see much higher fees and higher spreads that the banks charge relative to what they would charge even a weak credit that's approaching bankruptcy. It also is useful because it can preserve relationships with the company. If the company does successfully reorganize, the lender's well set up to continue to provide a securitization post-exit, which it may lose the relationship if it doesn't continue through the bankruptcy or participate in some sort of orderly wind down of the facility. And then also, as we know, it's a small world. A lot of the companies we see are portfolio companies of funds. So the relationships preserved here are not just with the borrower itself, but also its fund sponsors who tend to appear over and over in many of these deals, and by showing how it can be a cooperative partner, that's also a source of future business. Our firms worked on a number of these deals. I think we have more experience than any other firms in this area, and it's something we're very eager to talk about, especially where we see increasing potential for this structure to be applicable to additional deals. There's some other factors you should consider and other protections. So if you do have any questions, please reach out to us. We're very happy to talk about it. So I think with that, I'm going to turn it back over to Pat, who's going to give us some updates on trade credit insurance.
Thanks, Evan. So over the last few years, we've sort of steadily been seeing more and more use of trade credit insurance in receivables transactions. So I think there's an important distinction to be made between how trade credit insurance is used in securitizations versus how it's used in factoring. Typically, in a securitization, you get the trade credit insurance policy with the SPV as the insured. And in return for doing that, typically you substitute sort of the credit of the insurer for the credit of the underlying obligors. So you use that to get larger concentrations for eligibility purposes than you would if you relied on the underlying credit of the obligors without augmenting that with the insurance. In factoring deals, it's a little bit different because typically the bank isn't willing to finance the receivables at all without the addition of the trade credit insurance. So, it's typically an eligibility criterion for certain, weaker obligors that trade credit insurance policy be obtained in order for there to be any sales of receivables by that or owing by that obligor to the financing entity. And then there were just a couple of issues of note that I wanted to mention, in connection with these policies that are important to the extent that you're intending to utilize one in connection with these deals. The first is the concept of an insurable interest. So in order for there to be a contract for insurance, the insured must have an insurable interest in the subject matter of the insurance. So whoever the insured is has to have an insurable interest in the underlying trade receivables. So one thing that you want to really watch out for is if these receivables are being sold on to the, especially like in a factoring deal, for example, if they're being sold on to the bank, then the bank has to be an insured under the trade credit policy. Otherwise, they don't have an insurable interest, and the insurance company very likely is not going to pay out on the policy, which would obviously be a serious issue. And in a securitization context, typically the policy is going to have the SPV as the insured because they're the one with the insurable interest in the underlying receivables. The next probably more interesting thing to think about is true sale considerations when using these policies. So this is more of an issue for factoring transactions. However, something that we've been seeing a lot of is, as standard in pretty much, every insurance policy, there's going to be a deductible, a first loss deductible that, the insured is going to have to take with respect to any receivable. Typically, that's about 10%. So if you have a $100 loss on a receivable, $10 is going to be taken out and you're only going to get paid $90 by the insurer. So, the issue there, obviously, from the bank's perspective, the bank who's purchasing the receivable, is that they're still going to sustain a large loss even if the insurance policy pays out. So a lot of times banks will try to add like a 10% recourse tranche, first loss tranche, with respect to any insured receivables. If you do that, in that case, then if there is a loss, the seller of the receivables has to pony up the first $10, and then the insurance company is going to pay $90, which covers the rest. And by doing that, you've sort of eliminated any risk of loss on the for the purchaser. But that's a serious issue, from at least something to think about from a true sale perspective, because one of the cornerstones of whether or not a financial asset has actually been sold as opposed to pledged for security is, has the risk of loss been transferred to the purchaser? If it hasn't been, and essentially all of the risk of loss is still on the seller plus the insurer, then you have a question of whether or not you've actually transferred any risk of loss and whether or not there's going to be a true sale. So that's an issue. Another issue is, given that the typically the insurance is provided or at least obtained by the seller of receivables, a lot of it is in their court, and you're going to want to make sure that as the financier, that the underlying seller is actually, maintaining the policy correctly, that their representations and warranties regarding the policy are true, and that they're doing everything that they can to make sure that, to the extent that you have a valid claim, you can make the claim and get paid by the insurer. However, you have to worry about a situation where, the reps and warranties essentially say that, to the extent that there isn't a payout, then the seller has to pay you what the insurance company otherwise would have paid you, because under certain circumstances, that's really just recourse, and you're not actually, and you very likely run the risk of damaging the true sale analysis. So, probably one of the main ways that we've seen banks avoid this particular issue is just obtaining their own credit insurance on the back end. Totally not even mention the documents. They'll often just have an umbrella policy that sort of covers their purchase portfolio. And that way you can sort of completely, remove any references to insurance, any potential true sale issues there, and really cleans up a lot of those issues. But, that's obviously more of a business point.
So this can take a few different forms. Some ones that are just stepping back. If you consider a typical trade receivables securitization program, you'll have an originator that sells all of its receivables upon origination to an SPV, and then that SPV will finance them with the bank. The receivables are all relatively uniform. The originator is typically operating in a single line of business. The terms of the receivables are going to be, they may be documented on the same contract. The servicing of those receivables is going to be done by the same company. It's going to presumably service all the receivables in a consistent manner. It's going to prepare reporting both, for internal consumption and for external consumption, using a single database and a single set of metrics to produce that reporting. And the company doesn't get to pick and choose in real time what receivables are in the facility. They just all get sold at origination. As I mentioned earlier, the relative uniformity of the pool is something that is a securitization is often trying to solve for by trying to avoid lumpy excess concentrations and similar. But there's ways you can work within the traditional structure to add a little bit of leverage, and there's also some other structural considerations that are possible as well. So sort of working within the typical transaction, something we've seen is a financing of a sort of the subordinated interest or residual interest in the receivables. For instance, when the SPV acquires receivables from the originator, it may pay for a portion of those in the form of subordinated debt. So in paying for the receivable, it then owes money back to the originating company, that is paid for in part through an IOU. What we've seen is the originating company then entering into a financing secured by that subordinated note. So effectively, the money it's owed from the SPV out of the residual to pay for those receivables can support this, corporate level loan from the company. Another feature we've seen are mezzanine facilities. They're less common in trade receivable securitizations, and probably more common where you have a relatively distressed originator or other unique circumstances that would interest a fund. Some of the challenges with that structure can be ensuring that there's a high enough spread to make it appealing to a fund without excessively diluting the Class A lenders' return. So that's another possibility. And then other possibilities we've seen have been back leverage facilities where you might have an aggregating company that'll buy up trade receivables or all sorts of other sort of receivables that are financed in various structured facilities, and then use those and borrow against those. Those sorts of facilities add some additional structural complexity because the lender is now a step removed from the origination and servicing of the assets. Rather than having a uniform pool and uniform reporting, you're going to have receivables from all sorts of different places. You might have originators that compete with one another in the same pool. You may have You may have different sort of types of receivables. The way the company's reporting may be produced may be done in an inconsistent manner that needs to be harmonized to understand how the entire pool is performing. And then you also have a more limited recourse because you're a step back from the origination and servicing of the receivables. You're often in a situation where you're going to be forced to live with the facts on the ground in terms of servicing and cash management, and have a more limited ability to sort of box that in and limit what's possible. So, and then as far as recourse back to the originator, you may be limited to the sponsor of this, back leverage vehicle. So, typical structures we see here would be a bad boy guarantee, similar to the personal loan or credit card space, as a possibility. Perhaps there'd be, within the parameters of true sale opinions, a guarantee on some portion of the pool, or you might see a performance guarantee or similar. There's sort of a different gamut of possibilities in these sorts of structures. So as we point out, we've given a few presentations on this topic, and it is a hot topic that probably deserves its own separate presentation. So with that, I'm going to turn it back to Pat.
Thanks, Evan. I think this is the last thing we wanted to touch on. It's really more of a footnote here, but one of the products that we've seen a real lot of interest in recently is inventory finance or inventory monetization. Over the last few years, there's obviously been a lot of snags in the supply chain that have been, showing up in articles all over the place that I don't need to remind you of. But it's become a very hot topic recently. We've had a few conferences, in New York in April and in London in May, and far and away the topic that generated the most interest was inventory finance. So, that definitely deserves a podcast of its own. So we'll just leave it there for now, but just keep that in mind.
Thanks, Pat. And thanks for all of our audience for listening. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayerbrown.com. And thanks again for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayer Brown audio programming, visit mayerbrown.com/podcasts. Thanks for listening.